First of all, some comment, okay? I noticed that almost all of you have registered. I have also have noticed that almost all of you joined a group. I see more people are joining, which is nice. Let me just make sure. I have to accept everyone, so I apologize that it takes some time. Let me just remind you that you need to register. You go to my account, you go to management, and in management, you have the course. You can see the course that you have registered. You should have really one course, and the course that you should have is, well, I don't see it's in here. I myself, no, here we go. It's go to corporate valuation, IDC, blah, blah, blah. You click on it and then you register. You really should. Let me do it myself. I don't think with this account that I just logged in, I'm registered. So let me do it with you just in case someone misses it. I want to make sure that everyone is registered. So let me log out, log in. I will go with student and sign up, sign in. Then I'm going to courses. I go to the corporate valuation register. And then there's two courses. You are on 11:30 to 1. So I click here, I'm registered. I can go to the course now, and here we go. The other thing is that when you go to my account, you should have in management, you should see this course, and here we go. Where is it? Here we go. It's the second one. This is the one I just registered to. Here I just have other courses that I teach and demonstrate it. Assigned to team.
It's actually the last one.
So
it's actually four. Yeah.
The number 4?
It's this one, yeah.
Okay, good. So I go here, and by going here, you see your team. I do really please make sure that everyone at least puts his name. Putting your picture would be nice that other people know who you are, but it's not necessary. But I see you did a good job here. Everyone did a great job here, okay? I think almost all of you, just in case. And one more thing, I noticed that most of you already have done. Here you see the company name. That's perfect, okay? If I want to join to this group, I just click add. Very simple, okay? And the other advantage is, first of all, we have all the groups, but let me show you another thing. This one is a group of 3, very good, excellent, excellent job, good. Now, why do we really do that? This is very important. When you do the, let me just accept some more. Okay. When you go to the course, you can go to the course right from here, or you can go to the simulation right from here. I'm not sure that this one works. I fixed it. I think that last week I noticed that this one doesn't take you to the right place, but it does. I will do another upgrade this weekend. But in any case, you go to courses. Okay, this one definitely works. This takes you to the simulation, that takes you to the course. I want to emphasize some point. If you noticed, in every section, there is a little button that says take a test. Please go over it. Many times in the homework, I just tell you, please do it, okay? And I invested a lot of time building up this structure and also writing those questions. Those questions are really excellent review questions, and also teach you. By knowing the answer, they teach you. And let's say even a question you don't know the answer, okay? I just make it up. Let's say this question, I'm reading the total cash flow to shareholders and debt holders, meaning investors, those two together are investors, is the sum of. And you're reading them and you don't really know the answer. Many times by clicking, you know, this is wrong, so it cannot be the right answer. You click on the other one, okay, this is the right answer. Then you can really learn what the right answer by doing this exercise. I'm not testing you in order to test you. It's mostly for you to prepare for the exam, and getting immediate feedback. It's an excellent approach, which I have noticed students really liked it. It's the only second semester that I'm, well, last semester it was halfway done. This semester is going to be complete. You know, just for the first section, you have almost 20 questions. Excellent summary of the first chapter and what we discussed in the previous sessions. So please do that. That's your homework most of the time, unless I will add more stuff. So if you click here, please notice. Many times I just tell you, you have well, you have not, okay. The questions, review the questions in the end of chapter 1. That's the one, if you're going to chapter 1, in the end of the chapter, you have questions here. Okay, I put those in the blog so you can discuss them. Anyway, if you notice, everything I do here, it's to make your life as easy as possible, yet to study as much as possible as well. Okay, so please do go over those questions, discuss them in the blog. Okay, that's what I mean here by this homework. So I expect each one of you to make some comment there and discuss it so you learn. I might put a question like that as an open question in the exam. Okay, that's one. Second, please do go over those take a test. Go to the next topic. We talked about accounting last session. This is not an easy one, although it looks very easy. Okay, it is not. We have 3 financial statements. We talked about them last session. I fixed the error. It's already an error as much as putting the right numbers. This one is the dividend, so I fixed that one as well. And please do study these connections between those 3 statements. One, the balance sheet, income statement, and statement of cash flow. This is an extremely important one. And if you look here, we see how the numbers come from the income statement, interest expense we're adding here, and we're adding those 3 accounts in the end of the statement of cash flow. Anybody had a chance to review the session? I uploaded a recording. Are those helpful, or you want me to add, change? Please, anyone can help? Anyone?
I haven't had a chance to review it yet, but I definitely think that it will be helpful when we're studying, especially for very technical stuff like the last class that we had.
Excellent. And other things, by the way, if you want, it's your choice. If you guys want to write a summary of every section and I will upload it to the website, I don't mind to do that. I might even, if you want, I can review it a little bit, but most of the stuff are really good. If you look at the book, in my opinion, it's one of the best books that I know since I was in this field, since I started this field. It's excellent book. It's easy reading. It gets tough a little bit on as we make progress to other chapters, but chapter 1, it's easy reading. It's already that hard. Chapter 2, it's not hard either. Many concepts here we will discuss today and the next few sessions. But if you ask me which book is one of the best, I would say definitely this is one of the best. It's get a little harder, and I will mark for you what do I require and what I don't. For example, this is a good example. Go over it. It's very simple. It's a very important. For example, this is we haven't covered it yet. It's very good equations. We will use that. Please do go over the book. The next part that you should read is chapter 2, and I will lead you as we progress. The link to the book you already know, there is in the introductions, okay? If I'm not wrong, it was right here in the bottom. It's right in the bottom. As we progress, I will add every session again to the end. So you will have by the end of the semester, you will have all the recording. I noticed there is no point to put all the sessions like this session and the next one. When I edit them, I just pick the best one and I will just put them. There's no need to, but it's basically the same recording. Okay, good. So let's see what next. We did that one. Questions on this one, and don't be shy. I will spend as much time as needed. This is not easy, okay? Especially if you're not really an accountant and don't have 5 years of experience. So it's really a little hard. Anyone have questions of our last session? Please go ahead. Okay, everything's clear? So let's push it a little bit, okay? And hopefully by the end of the day, we're done with the accounting and we already moved forward to other stuff, okay? Let's move to the next one. What is intrinsic valuation? And here, intrinsic valuation, basically, we're doing a discounted cash flow. You have studied that in finance. Then you'll ask, why do we go over it again? And the reason we're going over it again is because you're making a lot of assumptions and you don't even notice. Things that seems like so clear and easy in real life to implement them, they are extremely hard. Let's start with the easiest one. We're talking about expected future cash flow. Where can I get that number? Well, you won't find it anywhere. You'll have to make some assumptions, some predictions. And we'll talk about several ways you can look at it and how to do that. Which cash flow? So last session was useful that we talked about, you know, if we had, let me open another one. Yeah, if we have the financial statements, we can tell about the current year. We can tell about the current year that the free cash flow for the debt holders and the equity holders is the total of those 4 accounts. And for this current year, it was $239,250. But I don't know the future. So I don't really know what will be next year. I don't really know what will be 3 years from now. Definitely not to the infinity. So theoretically, we would like to know this number from now to infinity and then do a discounted cash flow. How can we do that? We almost don't really know what the future will lead, and we talk about it as we progress. Another thing that seems like obvious, and it is not, okay, which discounted rate should we use? What is discounted rate? Is it the interest rate? Is this the return on the equity of the company? Is it the WACC you studied in finance? And let's say we assume we know what it is, and in a minute I'm going to dive into it. How do I take all the components? For example, in WACC, using risk-free interest rate. What do we mean by risk-free? And those will come as we go along during the course. Seems easy, but in real life, it's really complex. Okay?
Amos, could you re-explain what WACC is again?
Yeah, WACC is weighted average cost of capital. And in the finance course, let me write it, although it's written somewhere, it's WACC, it's equal to RD, which is the interest rate on debt, times 1 minus T, which is the tax rate, times the weight of the debt relative to total value of the company, meaning total debt over the value of the company, plus RE is the return on the equity times the weight of the equity or as part of the total value of the company. That's the WACC, okay? So we have a weighted average of after-tax return on debt and return on the equity. Why it's a weighted average? Because here I'm taking the weight of the debt relative to the total company, value of the company, and here I take E over V. Now, as you should know, V is equal to E plus D. So if you do D over V, it's really the portion, the share of capital invested in the company as debt relative to the total investment, and E is the share of the equity. Is that clear?
Yes, thank you.
Yeah, that's from the class in finance. You might have seen that before.
Any criteria, like there will be no reason.
Let me just mute everybody. Will be quiet. Okay. Okay, very good. I will open up to allow you to jump in. I will make a pause all the time. So, okay. So I can minimize this one and let's move on to the next. Then what is terminal value and why we use it? You know, when you look at the cash flow from now to infinity, it's kind of will be a little odd to try to estimate growth rate for every year from now to infinity. It's a really nonsense. You might have studied the Gordon equation. If you haven't, in any case, I'm going to cover it in this course and give you some exercises to do it, okay? So we need those really three components to do a discounted cash flow. And we need to know how to measure each one of them, okay? So when we talk about future cash flow, what do we really mean? We'll go and cover it. We talk about discount rate, how do we measure it? And we have to make sure that we're taking risk into it. And how do we measure risk? And how do we include it in measuring discount rate? Should be a topic we have to address. I mentioned here the next point that certainty equivalent. If you ask an economist, they all like to think in terms of certainty equivalent. In real life, you barely use it, okay? And the idea is a nice theoretical idea, but I won't get into it too much in this class, okay? So I will skip it. I just wanted you to know it exists. In the book, they have a little discussion on that, so please go and see it there. I would like to use the time for other more complicated actual stuff that you actually use in real life, okay? So we use expected future cash flow. Okay, so let's say we have a future expected cash flow of the future. We do a discounted cash flow. That's the value of an asset. Very simple. Please just tell me if you covered it in your course in finance. Is that right? Anybody?
Yeah.
You covered it, very good. So that's very easy. So when we do valuation, many times we take this discounted cash flow, we look at the first few years, and then from a certain point to the infinity, we make some assumptions, and we use Gordon equation to calculate what is terminal value. I will go into detail how we do that when we get there. But theoretically, it is like we're taking the infinite sequence and splitting it to two. One is for the short term. That's what we call short term, let's say 5 years. For you, I will ask for 5 years. In real life, it can move between 3 years to 15 years, depending on the type of a company. If it's a company that's already mature, then the short term and the long term, it's the same things almost, because it's already mature and I'm not expecting any special increase in growth of revenue or something like that. If it's already stable, that's what we mean steady state, then everything is a terminal value. But on the other hand, if I have a young company which is growing very fast. If we have a young company that is going, sorry about it, if we have a young company that's growing, so the period of startup could take about 15 years until they get to maturity. And I would need to estimate more or less in those 15 years what might be the growth rate. Many times you might even split it to 3-5 years. And you say, okay, the first 5 years there's a big growth rate. The second 5, it's a little smaller, and then smaller, and then it gets to maturity. It might sound like vague at that point, in this point, but as we go along and I will demonstrate, it will make more sense. The key point here is that we take the sequence and split it to 2. Part 1 is what we call short term, and from here to the future, we call the steady state stage, and that one we calculate using a formula known as Gordon equation, and I will dive into that as we go along. Okay, next part, which is extremely important, when we're valuing a company, what are we exactly valuing? Are we valuing the equity? Are we valuing the debt only? Are we valuing the enterprise? And when we say enterprise, we mean the value of equity and debt together. Okay? And you might be asked to value each one of them in real life. Let me take the harder and the easier, I would say. It's kind of contradicting sentence I just said. It's hard in the sense, it's easy because it's easy to do. It's hard because you don't really understand why is it hard, okay? What do I mean by that confusing sentence? Let's say a company issued bonds, and the bonds is very clear. It gives 10% coupon, and the bonds is for 20 years. So far, so good. Let me write it down, okay? Or easier to. That's how we have a company issuing bonds for 20 years, paying 10% every year. And let's say that's what you know, okay? Anybody want to tell me what is the cost of debt for this company? This is the only debt that they have. And the principal is 10 million. Fair enough? Anybody wants to say, how will you go about it? What is the cost of debt in this example? Go ahead. Any volunteer?
10%.
What's the wrong answer? Why is it the wrong answer? Do you want to guess?
Well, I mean, that's their cost of borrowing. They have to pay debt holders 10% every year. So would that not be the rate that you use?
Well, what is missing here in my information that I kind of cheated intentionally? What is the missing here? You assume that the company raised $10 million, they're right? How about if I gave you another detail and I told you in real life, when they issued those bonds, they were able to sell them only for 15 million. In other words, that's what I call the market value of the debt of bond, of the bonds.
I'm sorry, Amos, could you explain that again? The 15
Yeah.
million, where that came from?
Yeah, definitely. Here we go. We have a company issued bonds for 20 years, paying 10% every year as a coupon. That means in real life, that's translated that they are paying 2 million every, they're paying a million every year. Why they're paying? That's really the interest expense. Is that right? They're paying it as an interest. Why? 10% of 10 million, it's the principal, so the company is paying 10%. 10%, it's 1 million. Then I asked, what is the cost of capital for this company? Is that 10%? And somebody said, it is 10%. And I said, well, I cheated you. And I did, because I didn't give you what the market value. What do I mean by that? When the company issued those bonds, that's what they promised the investors, whoever will give a loan to the company by way of buying those bonds is expecting to get 1 million. But he said to the company, I'm willing to pay you much more than 10 million. I'm willing to pay you 15 million. What does that mean? Anybody?
Does that mean that the market value of the bonds today are valued at 15 million?
It's 15 million exactly. And
No,
therefore,
today, though. So
therefore,
there's an interest rate that's less than 10%.
and then it means exactly beautiful. Then, in order to find what is really the cost of capital of these bonds, we have to do the exercise of doing that 15 million should be equal to the net present value of getting 1 million every year over 20 years. Is that right? And the implied rate that I'm looking for, the RD that I'm looking for, should be calculated by making it, this is for, we're getting 1 million every year, okay? 1 million every year, that's the cash flow. We have it over 20 years, and the discount rate should be, that's what we're looking for. That should give me the 15 million. You probably have studied Excel, and there are formulas that do it automatically, and then you can ask, what is the rate in which this equation will hold? And as you can guess, it has to be lower than 10%, okay? That means the person that bought that debt from the company was willing to give a loan to the company in a lower interest rate than the coupon rate, okay? By the way, if I change the detail to saying here 10 million, that means the company issued those bonds for 10 million, okay? And the principal is 10 million, you immediately can say the answer for what is the RD that will solve this equation, it should be 10%. You should know it from finance course. Okay? If I told you that companies were willing to buy it's for only 8 million, then the RD must be higher than the 10%. I will leave it to you as an exercise. Okay? That's something you should cover in the finance class. Okay? But I hope the question at least is clear. And if you have a problem, please send me an email. I will make a note and I will document it in some way so it will be easy for you. But this is an excellent exercise for you to understand the link between the principal and how much the market value of the bonds and how we calculate the RD. We will revisit this issue again when we
Can I ask a
get
question?
to cost of debt. Yeah, go ahead.
If the market value was like 10 million, that's like par. That's like if then the bond would be at par. Is that like what it's talking about?
No, the par value. This is the par value, the principal.
Oh yeah.
That's
okay.
the par, what known as par value.
Okay.
Okay, this one is the actual amount the company have raised by issuing the bonds in the stock exchange. Okay, all the amount of money the company was getting from the bank still they had to pay those amounts to the bank every year. Okay, we'll revisit that one when we talk about cost of capital. But that's just an example. So although when you studied finance, those questions weren't there, they're really important when you do valuation. Okay, so knowing to do valuation of debt, of doing valuation of equity, each one of them has its own difficulty, and we'll go over all of them. But one thing is very, very important, and that's really the next part. When we do a valuation of equity and we do a discounted cash flow, that's how we're doing this one for the equity, we must be consistent. If we do the expected cash flow for equity, we will use the cost of capital for equity. If we do it for the debt, we need to use the implied interest rate and what the cash flow for the debt. If we do them together, we take the cash flow of the debt plus the cash flow of the equity every year, and then we will use WACC. That's why WACC was important to mention before. Okay, I will repeat it. Consistency requires that if you do a valuation only for equity, you need the numerator to be the cash flow of equity and the denominator to be the cost of capital. In the R here, we mean cost of equity, which many times we'll mark it as RE, okay? If I do value of debt, I need to take in the numerator the cash flow that the debt holders will get every year, and the denominator, what is the implied interest rate. If we do value of enterprise, we must take in the numerator the total money or the total cash flow that the debt holders and the equity holders together receive every year, discounted by the WACC. It's a weighted average cost of capital. Is that point clear? Because that's really important. Don't mix it up. WACC is only when we're valuing the enterprise. RE, it's only when we value equity. RD, it's only when we value debt. Any questions? Is that clear? Okay, let's move on. I will skip that. This is really just another way to end, but let's try to do this one. Anybody wants to try to answer this question? That really looks like, let me make it a little bigger. Let me see this question. Anybody want to help or even read it out loud? Anybody? Volunteers?
I'll do it.
Go ahead.
I'll read it.
Go ahead.
You've been asked to value the chemical division of a multi-business conglomerate and have been provided with the cash flows for the division. What discount rate would you use to discount this cash flow?
Wonderful. First of all, just to clarify that, to make sure that everybody knows what conglomerate is. Everybody knows? Anybody doesn't know? Wow. Anybody that doesn't know, just say yes. I don't really know who said it. It doesn't matter. Okay. Let me tell you what conglomerate is. Conglomerate is a company that
owns several companies.
Again, one more time.
Conglomerate is a company that owns or have part of shareholders of several different companies.
Beautiful.
Like Berkshire.
Yeah, but the importance is, you're absolutely right. I would just add, different company means in different industries. So if I am a Coca-Cola, and let's say Coca-Cola is dealing only in the drinking or, only a soft drinks or whatever, then it will not be a conglomerate. Take Amazon, for example. Amazon is start turning into a conglomerate. Why? They started by selling books over the internet. Then they moved to Amazon Web Services, okay? And now they bought, about a couple years ago, they bought Whole Food in hope to get into the retail industry. So they are investing now in 3. There's some link between them, some synergy. So I wouldn't call it as a pure conglomerate, But when you have a company that dealing with several industries, they have several subsidiaries, and each subsidiary is in a different industry, that's known as conglomerate. Another good example is 3M. Look it up. It's a really beautiful company. One of my favorite. If I had to put my pension plans money into a company, only one company, I would choose probably 3M. They have 6 major industries. They're well diversified. They're really well managed, but so conglomerate is a company that has several subsidiaries, as you said, and each subsidiary is from a different industry. Okay, so we're looking at this cash flow, and the question is, we want to do the evaluation of a chemical division, because they have several divisions, and which cash flow would you use? The cost of equity of the company entirely, okay? Because the company together has several industries, and the cost of equity probably will be different than the cost of the equity in the chemical division, okay? If I said the cost of capital of the company or the cost of equity, notice this is different. The second one is the WACC. The first one is the RE, okay? The third one is the cost of equity of the chemical business. And the third one, the fourth one is the cost of capital for the chemical business. Which one do you think is the right answer? Anybody?
E.
D? Yeah, I agree with you. Can you elaborate? Anybody wants to help too? It is the right answer, but why?
Because isn't that how we said, I mean, in the first chapter, it spoke about how you evaluate a company is you take the expected cash flows and you divide it by the cost of capital. And in this case, it's specific to this sector. So their cost of capital for them was whatever percentage it is. But it's specific to them, whatever they got. So it could be 10%, it could be 8%.
That's beautiful. That's right. It's because what really wrong with C? Let's say A and B will skip, but what's wrong about C? C is only talking about as if you finance the whole thing as an equity. But if you finance the debt and equity, the right answer D. Or in another word, D is even including C inside implicitly. If you finance that by equity, the cost of capital of the chemical business will be exactly like C. But many times you will finance businesses in several industries raising debt and raising equity. So that's why D, it's a right answer versus C. The other one, talking about the company in general, and then if I have several subsidiaries, I cannot just go and take for the whole company, won't reflect the risk that I am having in that specific industry or that division of chemical. I should really take the cost of the chemical business. Beautiful answer. That's a good one. Okay, let's move on. That's clear. Questions? Good. I didn't really put that one in the review question. I just wanted to talk about it in class, but that could be a question for exam, for example, and you will see by the end of the semester, you already have plenty of questions or the style of questions I might put in the exam. Okay, let's go and finish with the devil, I call it. Devil, not in the bad sense, in the sense we have to deal with it. We have here Excel. By the way, you have the Excels here. I just put a screenshot here, so it will be easy for you to see it. Let me increase the image so we can see it's better. Yeah, here we go. Okay, what do we have here? I took a balance sheet and tried to make it a little in a diagram way. On the left side, we have long-term debt and we have the equity. And the equity we have the part that we raised originally as equity and the retained earning, and we talked about it last session. Then we have on the right side, we have long-term assets, okay, or net long-term assets. And we have, I split the working capital to the current assets to two parts, working capital and cash. Anybody wants to help? How did we define working capital? From accounting point of view and from a finance point of view. Anybody?
Was it current assets minus current liabilities?
Excellent. That's the
that
way.
was accounting, and then finance was you don't include the cash or the short-term debt.
Cash.
And you also short-term portion of long-term debt. No.
Okay, let me repeat. You said correctly. The accountant defined working capital as total current assets minus total current liabilities. But we as a finance people, in order to define working capital, we take cash out of the current assets. So
you mentioned in there that you also take out short-term current portion of short-term debt or something.
Hold a second, we'll come to that. We'll come to that. Okay, you're absolutely right. Two parts. You're absolutely right. So let me just complete the sentence. When we define working capital for finance purposes, from the assets, we take the cash out, and from the current liabilities, we take out the short-term portion of a long-term liabilities. Okay? Let me write it down. That's very important. Okay? Now I'm writing working capital for finance purposes. It's a short-term assets minus cash. That's from the assets point of view. Then I subtract current liability, and current liability, I will take total current liabilities minus short-term portion of long-term debt. Okay, let me just make it a little smaller so you can see it. Can you see it? Is that big enough?
Yes.
Okay, so from finance point of view, current assets mean current assets not including cash. I really should say, okay, excess cash. Okay, I won't kill you about that in the exam or in your paper. I will be soft. In graduate school, then you have to be more specific. It should really say excess cash. What do I mean by excess cash? Let's say if a company needs for operation on a daily basis about $1 million as cash, if the company has 5 million, then I should really subtract 4 million, okay? I should take only the excess cash. But if you take the total cash, I won't kill you about it. That will be fine. And even if you didn't take anything, that will be also fine, as long as you in your paper put a note there that you are aware to that, and you're just ignoring it because it takes you too much time to estimate it, and it's really hard sometimes to know how you define excess cash, okay? So for now, we will call it minus cash. And then on the other side, the short-term debt, maybe I will call it, let me call it short-term current liabilities. Okay, no, I'm duplicating myself. That's why. That's just to be consistent with the left side. Short-term liabilities. Short-term liabilities will include many times, okay, in case I have a long-term debt, it will include the part of the long-term that I'm supposed to pay in the next year, So if I took a loan, let's say for 100 million, and that is 100 million I'm supposed to pay in this coming year from the principal, and 400, that's over 1 year. So this is really a long-term debt. This is what I see in the financial statement as a long-term debt. And this part, it will be a short-term debt. And this will be part of this one. Therefore, we take it out from the short-term liability and put it back in the long-term liability. In another word, in this chart that we see here, we're supposed to have long-term debt. In the example I just gave, it should really say 500, okay? Because this portion, we take it out from the short-term liabilities, put it back in the long-term liabilities. And then this difference for us is the working capital. So let's go back to our example. Long-term debt, it's really should say long-term debt including the current portion. That's what we mean. In the first year, it was 14,000. In this example, the working capital is the short-term assets minus short-term liabilities, but the short-term asset not include cash, and the short-term liabilities does not include the short-term portion of a long-term debt. Then we have the cash, and then we have net long-term assets. It's a little hard, honestly, for people that you are only third year. We haven't had several years of experience seeing financial statement. Seems hard. Just go over it several times and make sense, okay? Okay, we do it for first year. Then we do it for the next year. Same terms, same definitions. And then we take the difference between the two. And the difference between the two, that's what gives us the statement of cash flow. And I'm going to go over that in a minute, okay? Before I go over that one, just to remind you, we have income statement. Go ahead. Somebody wanted to ask a question? Okay. Then we have the income statement, and last session we said that the difference between the equity or retained earning, okay, I can look at the total equity. What's the difference between the total equity? It's the beginning equity. I will add to that any issue of common stock, and to that I will add the net profit. I will subtract dividend. I would get the end of the year equity. Last session, we focused only on the retained earning. The change in retained earning, it's net profit minus dividend. But if I add to it also the increase in common stock, I would get to the difference between the equity beginning of the year to the equity in the end of the year. Let me go over it one more time. I see equity, total equity is 4,000 plus 2,600. So my beginning equity is the sum of those two. That's what we have, 6,600. So far, so good, everyone?
Yeah.
Yeah, good. Okay, the end of the year, I have 4,400, and then I have retained earning, okay, 5,550. Total of equity at the end of the year will be 9,950. What explains the difference between those two numbers? The difference is, one is the change in the common stock. Change in the common stock was 400. That's we issued 400 as equity. Then in addition, we have the change between 2,600 to 5,550. That difference we know from last session, it's the net income minus the dividend. And I gave you questions in the review questions. in the test, take a test. I gave you an example. Please go over it. That's a very important to know that that calculation, because this is really how the change in the equity come into place when you look at the real life financial statement. Let's go move to the right side. And I gave you also a question on this part. You know what? Let me open it. Okay, let me open it. Will give us a chance also to see how I'm building up all the stuff that you need for the course. Here we go. Here I ask a question, and I'm going to go over that before you answer it. I'm giving you a little, screenshot of this one. Okay, of the last part. And we try to understand what is that. And then I ask questions, and please go over the questions after we do that today. We have equity cash flow and we have enterprise cash flow. We said enterprise, it's the cash flow of debt and equity together. Equity is only equity alone. Okay? So, and then we're trying to understand how do I do a calculation of each one of them separately. So how do we do it? First line we use, it's the EBIT. What is the EBIT here in the income statement? Anybody? Here we go. That's called operating profit in many of the financial statement you will see. That is known as operating profit. Okay? That's the profit before interest and before taxes. That's the earning before interest and taxes. Okay, we're starting from that number. In both cases, we're starting with the same number. But then when we do calculation, cash flow for equity, we subtract interest. On the other hand, when we do the cash flow for debt holders and equity holders, we do not subtract the interest. Anyone wants to explain why, or is that obvious? Anyone? Volunteer?
Makes sense, because enterprise, when you're doing equity, you can't include interest because interest is part of debt. That's how you subtract it.
You're absolutely right, because I really want to know in the enterprise, in fact, the interest is part of the cash flow, so why should I subtract it? You're absolutely right. When I do it for the equity, well, this is the total earning before interest and taxes, okay? The equity owners are not going to get that interest, so I have to subtract it. So that's why we're getting to this line. So for enterprise, we do not subtract interest. It's nonsense to subtract it. For equity, when we calculate, we should subtract the interest. Very good. Then it's the hardest part. And it seems like nonsense. And as we go and we get to the WACC, I will explain why it makes sense. Okay? When we look, we have taxes. And how do we calculate taxes? It's the percentage from, if I recall, in this example, it's 35%, if I recall. I already recall. So you take 35% of 10,000, it's 35%. You take 35% of 10,000 for 56, that makes sense. That's the amount of taxes you should pay, okay? On the other hand, this one doesn't make any sense. We're kind of taking 35% out of the EBIT. And if you notice the number you have in the income statement, you have really taxes, 10,456. This one makes sense to us, but this one doesn't make sense. Why don't we subtract the interest first, okay, before we calculate the taxes? And the answer is a little more complicated. And when we get to the cost of equity and the cost of the WACC, I will explain that in fact, this is a corrections that we have to make. For now, just please remember, when you do taxes for the equity, you do it exactly like in the income statement. When you do it for the enterprise, you kind of doing it incorrectly, but it is correct in the end. And I will show you examples that will get the same results in both methods to convince you. By the way, if you remember when we calculated the WACC, we took RD times 1 minus T. Is that right? When we calculated the WACC, taking RD times 1 minus T, we in fact already took into account the fact that interest is tax deductible. And therefore, we must not do it again here. But that's really beyond your head in this point, and I'm aware to that. So don't be intimidated by that. I promise I will go over it one more time. It will make much more sense when we talk about the WACC. For now, just remember, you take the same tax rate and you multiply it by the EBIT. Okay, in this case, and here is EBIT minus interest. I always love to put a little question in the exam. Make sure that you remember that, and we understand it better when we get to that. The next part is net capital expenditure. Anybody wants to guess where this number come from here in this part? What is net capital expenditure? I promise this is the last session. We're talking about accounting in that heavy duty way.
Is it revenue minus gross profit maybe?
What is capital expenditure? Capital expenditure is, you know, how much money you spend to buy long-term assets, isn't it?
It's the difference in the net long-term assets this year, the net long-term assets in last year.
Yeah, beautiful. That's right. If I look at it, here last year we had 20,000 long-term assets. This year we have 25,000. So the difference is 5,000. We needed to use cash of 5,000 in order to make that increase. So therefore, if I'm looking at the whole company together, shareholders, debt holders together, okay, I had the EBIT. From the EBIT, I reduced the taxes, whatever I have left with, I had to invest 5,000 to increase the long-term debt. It's the same case, it's in the case of equity, but I'm going to put a question mark here, and I will going to discuss that again in a second, in a few minutes. Let's focus on the right side for now. Okay, and then I will come back to that, because this is kind of seems like doesn't make sense, but it will make sense in a second, okay? The next part is working capital. We have an increase of working capital, 500 went up to 750, to 750. That means we increased the net assets as we define working capital in a sense. If the assets went up, I had to use cash. So when we see the long-term assets going up from 20 to 25, that's required cash, and therefore we subtract 5,000. We also supposed to subtract the increase in working capital. Same logic, okay? The same logic. In order to have that increase, I had to use cash. Therefore, we subtract the 5,000 for long-term assets, and we subtract the 250, the increase in the short-term net assets, I should call it, as we define the working capital, okay? So the right side we're done. 2,196, it's the cash flow. We call it free cash flow for the firm, okay? That will be 2,196. I will pause a second and give you a chance to ask questions on the right side. The left side, I have to do some more work to explain that, okay? Questions? Anyone? On the right side. Anyone? Clear? Just somebody tell me that it's clear. No,
It's clear.
clear, Rafael?
Yeah.
Wonderful.
I will have to go over it again with the recording, I think, a little, but yeah.
I agree with you. You do have to go over that even twice. Don't be shy. It doesn't mean that you are, you're not smart enough. It's just accounting, in my opinion, it's the easiest topic, but it's the most confusing. There's only plus and minuses. So there's no real equations. On the other hand, it's, for some reason, for everyone, it's very confusing. So repetition or going over it a few times, then it becomes to be very clear, okay? Good. Let's clarify the left side. Left side, it's a little more, up to this point, everything is clear. We have the EBIT, subtract interest, we got, we have EBIT before EBIT, subtract interest, we have EBIT after taxes, after interest, before taxes, we subtract taxes. So far it makes sense. Then somebody says, okay, this is also makes sense to me, as you did on the right side. And I say it's not making sense. Why? Because this company is being financed by debt and equity. If a company is growing and spending money on increased assets, they should use resources from debt, the increasing debt, and they should increase equity to keep more or less the ratio between debt and equity at the same level. And I will have more examples as we go along. So let's look at those three accounts together. The first one, 5,000 plus 250, that's what the company needs cash to increase the working capital, increasing the long-term assets. Then, if you noticed, we have 2,000 of increase in debt. If we look at the total 5,250 minus the 2,000, that's the amount that we use money of the equity owners, because the company wants to invest 5,000 in long-term assets, 250 in short-term assets, and then part of this being paid by financing it by increasing debt. So how much money I'm using from the from the equity owners is the difference between 5,250 to the 2,000. The net of those three numbers gives me how much cash the equity owners actually that year have put in to increase the long-term assets and to increase the working capital. That's why we have increase in debt here. Here it's irrelevant because the 5,250 being financed by the debt and equity together. But here it's very crucial. To come up to the free cash flow for equity, we must see how much we're investing in long-term assets and working capital and how much we're financing it is in debt. That's why we subtract the debt in the end. Questions? That's a good point to make a little pause and let you talk, guys. Don't be shy if you don't understand it.
You said you just said you subtracted that, but you add back. You meant you add back the debt.
Yeah, because here it's in a minus. That's why
Yes,
you're absolutely right. It's the way you look at it from which point of view. You're absolutely right. Here I'm looking at the equity point of view. So it as if the equity, if they didn't get the money from the debt owners, they had to pay 5,250. But since the debt went up, that's why I'm adding it back. You're absolutely right. Okay? More questions? Good. So let's try to answer this question now. Here we go. And this video I'm utilizing, by the way, the review questions to really review also stuff that we do in the class. Okay? So here we go. We went over that in class, and here you have a beautiful question just to summarize. Do it at home. Okay? And the nice thing is when you click, you know if you got the right answer. Okay? Don't, if you don't get it in the first time, don't worry. Well, the answer is all the answers are correct. Many times I do that, so to make a little review for you. So by doing this question, you're really reviewing the session of today. Okay, beautiful. So here we have review questions. Please go over them. That's really a good one. Let's go to the next one. This is also question number 4. I put it to be as a review for the next part that I'm going to cover in a second. Okay, so let's see the next one. Anybody got lost from all those stuff? If you got lost, that means you are a normal person. If you didn't get lost, you must be a genius or you have exercised it many times. But in the end of the day, when you go over it a few times, it will be very easy. Okay, let's go and look at that one, just a summary. When we do discounted cash flow, I went over that before. Okay, I think I discussed it here, and I will go, let's see, I think there's maybe more people. One sec. Okay. Let's summarize the process of doing a cash flow evaluation using discounted cash flow. We have the cash flow. We have to estimate the growth in the short term. That's what I meant in the short term. Then we have a terminal value. We're going to use what is the cash flow supposed to be in the future. We do a discounted rate, and then we get what is known as a terminal value. We add the terminal value to the cash flow in the 5th year. Here I use 5 years as the short term. In many cases, you might say it's 4 or 6 or 7, as I mentioned before. I get the cash flow or equivalent to the sum of the terminal value and the cash flow for the 5th year. That consider as if it's my cash flow for the 5th year. You have done in finance classes the discount rate. Discount rate, it's very simple. How do I get to the 0.94? It's simply 1 over 1 plus the WACC. Fair enough? That will be supposed to be the 0.94. And if you see it here, the cost of capital is 6%. So if you plug it here, mean 1 over 1 plus 6%, you should get 0.94. Okay? How do you get the second one? Just square for it. The same amount that you got here, take this number, power 2, you get the discount for 2 years, and for 3 years, it's power 3, etc. Here it will be 0.94 power 5. That's the discount rate for the 5th year. Okay, why do we need a discount factor for every year? We just multiply the cash flow for the 1st year times the discount factor for the 1st year. That gives me the net present value of the first cash flow. The same things about the 2nd year. 2nd year, the cash flow is 1,050. The discount factor, it's 0.89. Therefore, the net present value, it's 934. Same things we do every year. We take this row, multiply it by this row, we get the net present value of the cash flow of every year. The last year, of course, we're getting the net present value of the terminal value plus the cash flow of the 5th year. Okay? Then we're adding up all those numbers. We're getting the total net present value. I hope you have done that in the finance course. Did you? Anybody, please do let me know.
We never did this Gordon equation. How'd you get the 25?
No, this one I will go over. You're right. You might haven't. So for now, just accept it, okay?
Okay.
And as I said before, I'm going to cover it. By the way, let me just show you. So, well, I will show you in a minute. The next topic going to be Gordon equation, steady state. We're going to cover it. So don't bother with that for now. Just know the concept, okay? And we're going to spend some time of understanding the equation. We will practice it. And then I will give you another exercise to do at home. So you will know it by heart, okay? So for now, what important is to know is just the structure of how to do discounted cash flow. We have a short-term cash flow, we have a long-term cash flow. We turn this one into a terminal value using Gordon equation, and we're going to cover it in the next. That's why I marked it by yellow. I think it's yellow. I'm colorblind, so I apologize. And we will go over it. And then the last part you should know from finance class, how to do a net present value of any cash flow. You just calculate the discount factor. You multiply every discount factor by the cash flow. You get the net present value of every year. You add them up. You end up with the total net present value. So this company supposed to be worth, its intrinsic value supposed to be 27,790. Okay, that's the process. What component do we need? We need a forecast of cash flow. We need to know the growth rate in the short term and the long term. This is the short term. The growth rate is given here as a 5%. And then in the steady state, we assume growth rate of 2%. We don't really see it here, but as we go into the Gordon equation, we see how to use it. And then the starting year, it's 1,000, okay? So we need to know the growth rate in the short term. We need to know the growth rate in the long term. We need to know the cost of capital. We need to know how to calculate terminal value. But if you have all the data, then you just calculate it by the Gordon equation. So you don't need to be given, you can calculate it yourself. And then we perform the net present value by using discount factors. Okay, good. I added here adjustments. I intentionally didn't put it here. As we go along and we learn, we'll see that we have to do some adjustments to this number to arrive to the equity value. Okay, I will give two examples. One, when we do that, this is the value of the enterprise, equity plus debt. We must subtract the market value of debt. That's one thing in the adjustment. And I would go over that again, okay, as we progress. A second thing, we will talk about a company that has subsidiaries. And if we use a consolidated financial statements, then some of the subsidiaries might not be 100% subsidiaries. Sometimes they are 70%, 80%. And that's another complication we have to deal with. So it's too early to deal with them. We will do it as we progress. I will give a special session, a condensed session on merger and acquisition. And I'm not going to make you an accountant, but at least to understand why we do the adjustment we're supposed to do. For now, it's good enough for me that you know that you need a cash flow in the short term. Long term, you use it for terminal value, discount factor, you multiply and you get the net present value, you add them up, and from this one, you will need to do adjustment. The detail, that's why we have this course, okay? This is really touching in what you should have known from the finance course beside the terminal value. The rest we will do as we progress, okay? So here I mentioned, please read chapter 2, okay, for next time. Please do. And let me go over something else I would like you to go. Now, I really apologize. I know that these stuff are not really that simple, and they do require a lot of work and repetition. I put a question here, which I took from the Excel. I think the Excel is, where is the Excel? Why did I put the Excel? Not here. Is it here? Nope. Let's go here. It's not. Why is the Excel? I put it somewhere. Probably here. I put two Excels here for you. Yeah, here we go. Those are excellent Excels. I will turn them eventually into a simulation. My time very limited. This one is in the Excel. If we download this one, let's see that. That's really I made special for you. Theoretically, it's not supposed to be in my course, but from experience, I know if I don't cover it, I will lose you very fast. So that's why. This one, it's exactly the example we covered. If you go here, you see the equations. Where is the number come? This one come from the income statement. Here, we take the tax rate, which is 35% times the number right above. So you have all the equation inside. Please review it and don't feel like you are not smart if you have to go over it 3 or 4 times. I think I am as a student went over that at least 5 times until I really understood it and absorbed it. Secondly, please go over that. You have all the equations in the Excel, okay? It's where the numbers came from, how the calculation, you can see everything you have here. Then you have the next one. I covered it and I showed it in the presentation today. Then you have the final one. This is really what we saw. In fact, here, those two, I just put them next to each other. That's beginning of the year, end of the year, and the income statement. And that's the way we understood that one. That's one Excel. Please do go over that. Very important. The next Excel, this is a really nice exercise for you. Not this one. Why is that one? Oops. No, I had to have another Excel. This one, the one that I just showed you. By the way, the calculations are here, but as I promised, we're going to cover it more. So you have the whole things. How I got that number, it's this times this. You have it in the Excel. So everything's in the presentation. You also have in the Excel, so you can really study it by yourself. But I'm missing another one that I should have. And this one, it's not here. Hold a second, let me make sure. I think maybe it's in the beginning, yeah. I think it's this one. Okay, look at this one. It looks so naive, but there is so much structure here. And if you see, to make sure you review it, I put a question here. Where is that? No. I put a question right on this. This one I just took a screenshot of what we're going to talk in a minute, okay? And please review it. It's already a question to test you as much as to help you to see things that I should think you should notice and when you're reviewing this Excel, okay? So please do go over and try to answer it. That's an excellent summary of what we're going to talk about now, okay? So let's go. Let me even open the Excel. I think the Excel will make more sense to look into. Just let me find the Excel. Here we go. Good. Okay, what do we have here? Beginning of the year, end of the year balance sheet. That's X1, X2. By the way, beginning of the year, it's the end of the year last year. So we have the balance sheet. It's exactly as what we saw before, just in illustrative way. Here. This is the way you usually will see it. Okay? Then you have beginning of the year, end of the year. Then we have the income statement. We saw it before. Then we have a statement of cash flow. And I would like you to notice several important points here. This one we already covered. Okay? Beginning of the year equity, we're adding increase in cash in common stock, and we're adding the increase in retained earning, meaning net profit minus dividend. We get to the equity end of the year. Then, this is a little hard to spot immediately, and I'm going to make a claim. Every number in the statement of cash flow could be explained by the difference between the balance sheet in the end of the year to the balance sheet in the beginning of the year. You most likely haven't heard that in this way. I will repeat it. Every number in the statement of cash flow could be explained as the difference between accounts in the end of the year balance sheets to the beginning of the year balance sheets. So let's see, okay? And please go over that at home and go over that deeply at home. Let's start with the easiest one, things that we have done. I see here that I have the retained earnings have been increased from 2,600 to 550, 5,550. We said that this difference is the net income or net profit from the beginning of the year to the end of the year minus dividend. Well, what do we see? It's in the statement of cash flow. Here is the net profit and here is the dividend. So this minus this, exactly the difference between those two numbers. One more time. The change in the retained earning, it's in the statement of cash flow. We put the net profit here and the dividend here. The reason we put them in different places, because this one, as we said last session, this one trying to give me the profit from operation or the net cash flow from operation. That's why we put net income here. On the other hand, distributing dividend, it has to do with dealing with equity owners. That's why we put the number here. But basically, both of them are trying to explain the change in cash. What is the change in cash in this example? We're going up from 100 to 200. It's exactly the 100 here. And so on. Every number you see here, let's say the 250. Let's say anybody wants to help me how I got the 250 here? Anybody? That's a hard one. Don't be afraid.
It might be the difference in the balance sheet between the cash and the other current assets.
Let's try it, okay? Let's take other current assets, not including cash. We have 1,000 first year.
All the current assets this year from the.
Yeah, but I removed the cash. You see, the cash I put it separately. Oh, from the current asset without the cash, it's 1,000. For what is the short-term liabilities? 500, assuming that this one doesn't include any short-term portion of the long-term. That's the assumption I'm making here. So let's call it short-term liability. That's 500. What is the working capital for the first year for X1? That should be 1,000 minus 500. So working capital for the first year, not including cash, should be 500. What is about X2? How much is the current assets? Now here we have 1150. Is that right? Everybody agree? I took the number right from here. What is the short-term liabilities? 400. So I put 400 right here. What is the working capital for the second year? 750. We have an increase of how much? 250. So increase in working capital of 250, which is really from the balance sheet, it's 250. That's why we subtracted right here. Is that clear? Everybody with me? Hello? Anybody?
Yeah.
Most everyone?
Yeah.
Good. I will leave you as an exercise, okay, to see the other numbers. By the way, the 2,000, just that's very easy. 2,000, it's increase in debt. Well, how much was the debt last year? 1,400. How much is this year? 1,600. Here is the 2,000. Okay? Increase in common stock, 400. Yeah, no surprise. 4,000 went up to 4,400. So every number here could be explained by the difference between those two.
Can I ask a
One more
question?
number and I
Can I
conclude.
ask a question about the debt?
About what?
The debt.
The debt, pay
Yeah,
attention.
I see 2,000. What if you had short-term debt?
Short-term already calculated it as part of the working capital.
So when it's talking about debt here, it means only long-term debt.
Correct. So here in the working capital, we took care of the short-term debt and we took care of the short-term assets. In the debt,
What about depreciation
exactly. So, say again, one more time.
that we get from the income statement? Depreciation that we get from the income statement.
Yeah, the income statement, the only number we really need from the income statement, it's the net profit. And it's
No, what about depreciation?
about what?
Depreciation.
Oh, beautiful. That's exactly my last point that I want to make. Pay attention that here I have a plus and here I have a minus. And that's I leave you as a homework. What do you say? I'll give you a chance to answer it the last couple of minutes we have left. What do you say? First of all, you agree with me. I didn't really destroy. If I put 0 here and I put a 0 here, the statement would be just fine. Is that right? But we do that corrections in order to reflect the meaning of the first portion and the meaning of the second portion. And I will conclude with this one. See, let's start with this one. This company have raised long-term assets, net long-term assets, from 20,000 to 25,000. That means they have to get out-of-pocket cash to increase this one. But that's if I will say that they only spent 5,000, that would be wrong. Why? Because here it says net long-term asset. That means not only they increased by 5, they also paid to replace, broken equipment or whatever. So they have to spend money to replace whatever depreciated and 5,000 to increase the net cash flow, the net long-term assets. So the 5,000, it's to increase the net. And the 1,444, it's really for the depreciation from last year, okay, to replace. So if I would say I had 20,000 beginning of the year, they went down by 1,444. That's really, if I didn't buy anything, my net asset could have ended up only sorry. That's what will be that amount. But I ended up with 25,000. So what is the difference? Exactly 6,444. Therefore, if my net was the beginning of the year 20 and I ended up with 25, I take this difference, that's the 5, and I will add the 1,444. That's kind of concluding this part. This one I leave you as an exercise. We talked about it last time. What do you say? Everybody happy? If you're confused, you are normal, okay? If it's overwhelming, you are normal. The only way to overcome it is just repetition. And that's why I added this one even as questions for a homework. Where I put it, here we go. If you see next one, I think I put it somewhere. Let's see. Yeah, here we go. I just really, to review what I just said now, I gave it to you as an exercise and try to answer if that's correct. And then you have also the Excel. You can see all the equations and really go over that 3, 4, 5 times and you will master it. And then we can really move on. Okay, thank you guys. Questions? Last minute? Everybody joined the group already? Anybody didn't join the group? Hello? Anybody? Hello, guys.
We
Most of
joined.
us have a group already.
Yeah.
Okay, wonderful.
Yeah.
Don't be intimidated. These two sessions are the hardest from accounting point of view. So, and I know that you had accounting classes. Some of you first year, you must have forgotten a lot of it. We will need that in this course. So that's why I dedicated those two sessions. Okay. Good luck and see you next week. Don't
Thank you.
hesitate to send me emails, any question, any suggestions to improve the way we cover this course. After all, I don't see you, you don't see me barely, and I don't get the feedback that I usually get from a normal class. So please, any suggestions, don't hesitate, send me, and any questions you need to, I will be very happy to answer. Thank you.
Thank
Thank
you.
you, Amos. Thank you.
Thank you, Amos.
Can I
Thank
ask
you.
something?
Yeah, definitely.
I don't understand. Will we have to write a paper or will there be an exam or both?
It will be both.
Both. Okay.
Okay.
And
I'm very glad. In fact, a student asked me and I asked him to raise that. And as I know myself, I always, many times, excellent. If you notice, in all my sections, you have homework, or
Yeah.
assignment. Here you don't have any homework, but you have assignment. Assignment, what I did is to help you prepare the paper and don't wait for the end of the semester. I give you assignment. So that was the first assignment. Then you have, for next week, you will have this assignment, okay? And then here I describe, do SWOT analysis. I gave you an example. I describe the assignment. You do it in a group. By the way, you can share material. You can upload a file and only your colleague in your group will see it. And then eventually when you decide which one you want to keep, just keep it and delete the rest. So it helps you to collaborate. I'm only giving you a grade toward the end for the final assignment. The final assignment will be adding up all the assignment and write a conclusion. So we're splitting the paper over the assignments over the semester to make your life easier. And I give the assignment in line with what we learn over the weeks. Is that clear?
Yes. So the grade will be
30% the assignment, 70% the exam.
okay.
Now I'm helping you to prepare for the exam by taking those tests, okay?
Yeah.
This is really excellent preparation for the exam. So if you really follow over the semester, you shouldn't kill yourself before the exam. You really shouldn't. You
Okay.
should really,
The exam is multiple choice like this?
in fact, I usually don't like multiple choices, but I notice that it's really good to help you to study, okay? And I will give you examples toward the end, examples of how the exam going to look like. I might put sometimes I put some multiple choices, sometimes I put it as open and sometimes I combine. But those multiple choices, I hope you like it. By the way, I would love to hear you comment if you like that way of adding those questions. Do you like this method?
Yes.
Yeah, great. I'm happy to hear that. I spent a lot of time building up this framework. In fact,
No,
it's
it's
my
good.
startup. We're doing it for other purposes. And I asked my employees to build it up for me. And I hope it's helpful. Okay. Thank you, guys. More
Thank
questions?
you. Have a nice
Yeah,
week.
Amos.